You are likely to have heard about NVIDIA regardless of you are buying or not buying stocks. And if you have bought NVIDIA, when is a good time to sell the stock? And if you haven't bought stock and you regret about missing the opportunity, are there still opportunity to buy? In this video, I will estimate NVIDIA stock price per share and tell you my prediction about when is a good time to buy and sell the stocks. But before that, I will showcase a little bit of my previous investment experience. Here you can see that 1 year ago, I estimate that the price to sell Oracle stock will be around 135 to 184, from 184 to 227, and from 227 to 348. These are price 1 year ago I estimate that the Oracle can goes up. And you probably think that they are two different, and I will explain later. But you can also tell that 1 year ago, I estimate the price to buy the stock is about 58 to 77. And you can tell that I did buy the stock at 58 before. These are the Oracle stock price changes in the past year. My concept is there will be a difference between when to sell the stocks and when to buy the stocks. The price to buy the stocks depends on the company's value, while the price to sell the stocks can be affected by the market momentum and the mood. And here there's another example. It is my estimation for TSMC in 2023. I estimate the price to sell the stocks will be 230 to 280, from 280 to 320, and from 320 to 609. You can check the price to compare with my prediction. However, 1 year ago, I estimate the price to buy the stock will be around 87 to 141. And in this analysis, I can tell you why they are so different and how to make those predictions. The reason why the price to buy and sell the stock are different because there are two types of participants in the market. One is called investor, another is trader. Investor focus on a company's long-term growth. We check how much revenue and profit they can generate in the past of 10 to 20 years. While traders, they try to take the profit with short term, and they take advantage of the market momentum and the mood to make money. One of the example is the price changes for the N95 mask. You can tell that the price unsurprisingly jumped during the COVID when everyone's in lockdown and requires a mask. Well, they slumped ever since that. If you are a person or want to resell the N95, of course, during the COVID, you can mm, make money hand over fist, and the price you charge other people will based on how other people set the mask price in the COVID. However, if you are an investor, you want to invest in a company like 3M manufacturing the mask. If you make a decision based on the COVID number, you absolutely overestimate the company value because the company cannot sell the mask at this price in the future. So these are the difference between investment and trading. The reason why I talk about that is NVIDIA is one of the hottest stock in the past years and is a very good example to compare the traders and investor actions. I have been an investor in past years, but first I will show you how traders price the NVIDIA stocks and you can see how well they make the prediction. And then I will explain how as an investor to value the stocks. Investment banker and traders, analysts, they usually use a ratio called P/E ratio to compare the company with other company. So usually what they do is, say for NVIDIA or other semiconductor company, they will use the company's stock share price divided by their earning, their profit per share. The logic behind that is they see how many years of earnings you need to justify the stock price. For example, if a company make $20 per shares a year and the price right now is 200, then if you use 200 divided by 20, the results that implies that the current price require 10 years the company's earning. And then the investment bankers, the traders, will compare the P ratio with the industry. So suppose that the semiconductor industry average is 25, while your company has a P ratio of 20, they will see this company is cheap. And if your company has a P ratio of 30, they will see the company is expensive. As an investor, I do not price company like that. But let's take a look like how well the traders price NVIDIA with such method. These are the P ratio for the semiconductor company I calculated when I value TSMC Taiwan Semiconductor in 2023. What I do is at first I collected as many semiconductors company as possible so that the sample is representative. I have 32 samples. And then I will find their stock price for each year, calculate their median annual stock price. And I also found their annual earning per share. And I will use their stock price divided by their earning per share to see their P/E ratio in the past decade. And you can tell that these are the information I get. For all the semiconductor companies, the average P ratio is about 31, while the median is 17. Median just strip out those extreme numbers, like very high or very low number. It is more representative. But there are also some companies are losing money. So after I removed those losing money companies from the sample, I got the industry average P ratio for the money-making company is about 36, and the median is about 20.57. And then we will check with the traders and the investment bankers' logic. They say that if a company has a P/E ratio higher than the industry average, that means it's expensive and you shouldn't buy. And you should buy it vice versa. Here we have the immediate P/E ratio. You see that the immediate had P/E ratio around 4 for the early years, but it's gradually jumped to the over 10 in the 2019 and 2020. And in the 2021, the P/E ratio is over 100. In 2022 is 44, and in 2023 is 236. If we go with the trader's logic, you should not buy NVIDIA stock in 2021, 22, and 23. But in contrast, if you see the TSMC P/E ratio, you should buy it almost every year because the P/E ratio is lower than the industry average. This is not how I decide want to buy and sell the stocks, but this just show you what if we follow traders' actions. And this is the NVIDIA stocks after 2020. Here, I just collect information about investment bankers' predictions for NVIDIA stock because although we know the position, maybe they know more than we know, right? Many people like to say investment bankers, they have smart people, they must know more than we know. And let's see whether that is true. So I will tell you how to see the graph. This is the immediate stock price history. And here we have abbreviation for many banks. We have Barclays, we have JP Morgan. And then I check their price target for immediate for different time. For example, here in 2021, from January to May, here we have BCS. That means Barclays price target for immediate is from 13 to 16. And JP Morgan is from 16 to 17. And another time we can see here in 2023, from January to May, the JP Morgan update the immediate stock price from 22 to 50, and Bank of America from 20 to 50. You can also see that I marked several targets in red color. Those red color means whenever a bank has a estimate, has a price target in the opposite directions from others. So what I mean by that is if all other company upgrade the immediate price target while you decrease, I will mark your price target as right. So this is the history. If you see the graph, you can find three things. First, the traders, they seem to follow the stock price rather than predict the price. If you want to make money from anything like buy house, if you want to make money from buying house, you should have bought it when the price hasn't increased yet and sell it when everyone is buying, right? That is called investment. That's how you make money. But if you see the graph, I didn't see any bank see that NVIDIA stock will was 50 before 2023. And I also didn't see any bank say the stock will go 150 to 200 before 2024. It turns out that traders, they follow the price, they react to the price rather than make prediction. The next is like more and more banks, they jumped on the bandwagon when the stock increased. The investment bankers, they try to follow each other's. There are very few investment bankers give opposite forecast than others. And why is that? I totally know why that happens because most of my classmates in US college, they work in the investment banks, and I know how investment banks work and how they make money. So first, the way how investment banks evaluate their analysts is not by how well you beat the market, it's by comparing you with other bankers. So suppose that this year, if all other bankers, all other analysts achieve 50% return, while you only achieve 20%, it's still very high, but you will get fired. In contrast, if everyone else lose 20%, but you only lose 10%, guess what? You can always keep your job. So the investment banker's job becoming a job not so much to beat the market, to predict correctly the future growth, as to follow each other. As long as you are similar to each other, you can keep your job. The next is the pressure from the client. Most clients, they care about 1 year performance. Investment bankers, they have to try to get as much as return in the short term rather than focusing on the company's long-term growth. Another thing is for these investment bankers, they also advise other deals like merger and acquisition. They help the companies to secure loans, to issue stocks. So think about that. If, say, JP Morgan, they try to advise NVIDIA for acquisition, and you are an analyst that you found that the stock is overvalued, you will not have the guts to speak out. So those are the disadvantage for the investment bankers, and that's in fact our strength for our individual investors, because we don't have conflict of interest, we don't have to make money in 1 year, and we have a lot of time. So in the next steps, I will show you how, as an investor, to estimate the company's value. The most important part for the fundamental analysis for the investor is to understand the company's business model. It's about how the company generates the revenue, attract customers, investment is capital, and make and help growth. I just use a supply chain example to help you to understand. Imagine that you are a group of farmers and you cultivate many crops and you sell them to the manufacturer. And the manufacturer, they will make them to flour and they sell to the wholesaler like Costco. Costco and Walmart will sell to other small retailers like a Giant Eagle or convenience store near your home. You probably don't know how much money each step can make, but I think you can know with common sense that if all these farmers sell their crops for about 1 million to the flour manufacturer, when the flour manufacturer sell to the wholesaler sale must be more than 1 million, right? If Costco bought all this flour for 1.2 million, and when they sell this flour to others, the total sale revenue must be more than 1.2 million, right? That's just common sense. And if you understand that, we can see that this is from NVIDIA's own financial disclosure. In the NVIDIA 2024 financial report, NVIDIA said that their product and architecture support several multi-billion dollars end market. What does it mean? The end market means the final users, the final customers of the market. See companies like Microsoft, Amazon, Google, they purchase the chips from NVIDIA and then they use that to run their models, to sell their product, or to power their Google search. And other customers use Google, Meta, Amazon, Microsoft products. And this is saying that for those customers that at the end purchase this company's product, their total market is about multi-billion dollars. Well, we don't know how much money right now yet. We are sure that the revenue for the NVIDIA must be lower than this amount. And you probably also see that here you have architecture. What does architecture means? Architectures in the data management is similar to the architectures in our real world. Think about what kind of architecture we have. We have the railway, we have subway, we have railroad. Uh, we have harbor. Those are architecture, those are infrastructure that our world, our society have for other business operation. For example, if you are a business, if you want to sell a product, you need harbor, you need a railway, railroad to ship your product. That's called infrastructure or architecture. And NVIDIA is the infrastructure in the data center world. With knowing that, I can give you another example. Imagine that you want to estimate the growth of future revenue for a electricity company. The company power the whole electricity grid of the city. So the residential users will use that. Factory also use the electricity. Those shopping malls, they also need electricity. We know that this company is dominant in the electricity offering, but we are sure that the total revenues for these residentials, for this business, for this shopping mall must be higher than the total revenues the electricity company make, right? Otherwise, how those businesses make money? And by the same token, the immediate revenues cannot more than the total revenues for its customers. So if we know that, if I can know how much money NVIDIA's customers, OpenAI, Microsoft, Google, Tesla, Amazon, and then I also know for each dollar of this company sell, how much money they need to pay for NVIDIA, and that I can estimate NVIDIA revenue growth, right? But before that, I will talk a little bit more about NVIDIA business segment, what products and services they're offering. You can see that we have different business segment. The data center is the immediate AI chips for the AI training. What AI work is they will throw AI tons of data to train them to think like human. If you shop online, you buy some bread, and the website will recommend you some butter or cheese because usually people eat bread with those stuff. But for the AI, for the machine, they are not as smart as human. They don't know that. You have to throw them bunch of data. After so many observation, they learn, oh, when people buy bread, they usually also buy cheese or butter at the same time. And further, they also can maybe find a trend about if a person buy a type of bread, what type of butter or cheese they buy together. And then next time when people shop online, they will give recommendation. This is how data center. And then we also have gaming. For the gaming, for many video games, it requires very high resolution. It has sophisticated plot. So this is the gaming chips. NVIDIA started with the gaming chips in the early years and have gradually transformed to a AI chips offering. The professional visualization are for those people who do editing, photo editing, visual art. And the auto are for those vehicles. And not only like taxi, but also even some non-electrical cars, they need some basic function, basic programming, so they need chips. And another thing is many people talk about the potential market for NVIDIA is the Tesla robotaxi in the future. And the next is the OEM and other. For OEM, these are for those devices that do not require a very high processing power. For example, remote for the AC, it still needs some programming, but it does not have to be very sophisticated. You can also tell that NVIDIA has comparatively small percentage revenues from the OEM, and the major OEM suppliers are Qualcomm and AMD. That's why I'm also saying that you want to diversify your investment. Even the company who is not advanced in the data center still can have high growth. You can watch my previous video if you are interested in the AMD valuation. After knowing that, now we can estimate the immediate forecast, the future revenue growth. I also estimate those companies in the future. So right now I have the luxury to use this number. Here we show that for NVIDIA right now, how many percent of their revenues are from each company. We have Microsoft contribute to 23%, Google to 16%, and for the top major AI companies, they contribute 85% of NVIDIA revenues. I first use this different percentage divided by the 85% to say for this 85% of NVIDIA AI chip revenues, how many percent of them are from each company respectively. I will talk about later about the rest of 15%. And then since I have those revenue prediction, my work become easier. First, I add up these companies trading 12 months, the past 12 months revenues. I got their total revenues, and I use the NVIDIA AI chip revenue divided by this number. I know that for each dollar of sale for this company, how much cost they need to pay to buy the NVIDIA AI chip. We get 9.99%, which means that for Microsoft, Google, Meta, Amazon, Oracle, Tesla, collectively, if they have 100 sale, they need to pay $10 to NVIDIA. And for the next 15% revenue, I just use the estimated revenue growth for the AI market. It's about 28%, and I give it 5 years and gradually decrease to long-term GDP growth. But you may wonder whether I will underestimate NVIDIA growth. Many people say that AI is the future, everything will be AI, you cannot live with AI. NVIDIA is the king for the 20th century. The good thing is in the investment, you can always do some common sense check. One thing you need to know that regardless of how promising an industry is, it cannot grow outwin the whole GDP. Suppose a country, $100 billion GDP, even AI has a very high growth. It cannot have more than or even close $100 billion market size, right? Because if that's the case, how about other industry? So this is what I do. I first say they estimate the future AI market, not AI chip, but AI product for this company, also like OpenAI. I see how much estimated market AI market by 2035 is about $40 billion. And I want to say if this $14 billion is reasonable. I also know that the US GDP, forecasted GDP in 2035 is about this amount. So I use forecasted AI market by 2035 divided by forecasted US GDP by 2035 is about 8%, which means that after 10 years, the total AI market size will be about 8% of the US GDP. Well, right now, the AI only compromise about less than 1% US GDP. So that implies a 10 times growth in the 10 years. I think that is reasonable because US also have other business. It has financials, agriculture, manufacturing. If you give AI market a very high growth, how about other business? And you can also tell that this amount happened to close to my estimate. And now I get the forecast immediate revenue growth, and then my work become easier. You probably wonder right now this company only spent 10% of their revenues to buy immediate AI chips. What if that number increase in the future? I don't think that will increase much, and I will tell you why. In finance and accounting, there's a ratio called profit margin. Profit margin means for each dollar of sale, how much profit you can make. We can see that Microsoft, it have close to 50% profit margin, which means that when Microsoft has each $100 sale, 50%, about 50 of them become Microsoft profit. Here, I first multiply their operating margin with their weight of 85%. I get the weighted average margin is about 35%, which means for this company, for each $100 sales, they can make $35, which means they pay about 35 to cost. So the total cost is about 35%. Well, NVIDIA chips right now has already comprised about 10%. So I don't think they will increase much because the company they have other expense. They need to spend on research and development. They spend on marketing. They spend on human resources. For example, recently we saw the news that the Meta offer 1 million bonus to hire some AI engineer. Those are costs that are investment as well. I also do some adjustment regarding the Tesla. So right now Tesla has a low margin, is only 10% because right now there's is still mini making the vehicles, and I improve that to 25%, expecting that they will have higher margin if they do the robotaxi. And for the weight, I gradually increase Tesla's weight from 12% to 22%. And that's about 10%. And I subtract 2% for each of those companies. Why? Because every company, even the best company, they only can maintain a high growth for a while. And after doing that, I estimate the revenues that NVIDIA can earn from AI chips. So these are the revenues. And after that, the work become easier. I can run the free cash flow model. I have covered that in my first videos, and if you're interested, you can check for more detail. But here I just explain a little bit. Here we have different business segment. Remember here, NVIDIA with different business segment, they will have different revenue growth and operating margin. For example, the data center must have much higher growth than the gaming sector and can make much more money for each dollar of sale. So if you value the company as a whole, like investment bankers, you may overestimate the revenue for the gaming center or underestimate the revenue growth for the data center. So at first, I set different segment. See here, we have the gaming GPU. I have the current revenue and I use the estimated gaming GPU growth. It's about 25%. I leave that for 5 years and gradually decrease to the long-term GDP growth. The reason is any company cannot have high growth forever, and also the growth is compounding. Because like for example, first year if you grow 25%, the growth rate is 1 plus 25, and next year you will be 1 plus 25 plus another 1 plus 25. So this growth rate is compound. So I gradually decrease to 4%, and the profit margin for each dollar of sale. Currently, the gaming GPU make about 40%. I gradually decrease to the 30%. This is a semiconductor industry average. For the AI chips, I have the revenues I just estimated, and the current operating margin is 65%. It's very high, which means for each dollar of sale for NVIDIA, they can make about 0.65 cents. And that gradually decrease to 60%, still very high. And here we also have the auto. Another thing is that see from news that the U.S. The Trump administration has doing a around the world. We also see the tension between U.S. and China. How to factor in those effects? In the past, I will estimate the how much revenues the NVIDIA have for China. I gradually decrease that. But recently, Trump administration just announced that NVIDIA need to contribute about 50% of their sale to China, the government. So then I know how to do that. I first say how many percent of NVIDIA revenues come from China, and I use that and multiply by the 15%, we get about 3%. And I expect that this cost to maintain for 5 years and that gradually decrease to 1% and zero. Why? Because politics is the art of compromise. There will be some negotiation, and I believe that as time passes by, those tariffs will be either softened or lifted. Another thing is, even if NVIDIA lose the market for China, in the future they may have new revenues from market like India or Middle East. So this is how I incorporate the political and geopolitical risk in my valuation. Another thing is, even if a company is dominant in the market, there is still a possibility that there will be some competitor in the future. Just think about that. Many people like to say that NVIDIA is superstar in the AI chip. No one can beat it. Well, I agree it have high growth, but I don't want to exclude the possibility about the future competitors. So if a company has a 1 billion future market, and if you buy based on the 1 billion assumption, guess what? The company can have 800, 900, 150, $100 million. It is still a successful company. It has very high growth. But guess what? If you buy just based on 1 billion market size, you can still lose money. So I take the possible competitors into account. So here we can see that I expect the NVIDIA has no competitor for 4 years and gradually lose a little bit market. In the 10 years, if the NVIDIA will have 90% market shares with losing 10% market share to other competitors. It could be AMD, it could be other companies in China. But you may wonder, how do I know that it will lose exactly 10%? Well, I don't know, and I don't have to know. The good thing about the free cash flow model is you don't have to get a fixed number like investment bankers. What I do is I will try different number. Say, what if the NVIDIA lose 10% AI chip, 20%, 30%, and so on to others? After I got those free cash flow, I discount them to today's value. After I get free cash flow, I subtract the money the company borrow, I add the cash, and I divided the result by total shares. I estimate the share price. And here we can see that if the NVIDIA lose from 10% to 50% revenue AI chip market, how much the value per share will be. And you can tell the median is about $90, is just $5 difference from the if the company only lose 10%. I will buy the stocks if it reach to $90. I know many people, when they see the result, they will say, this is ridiculous. AI has a high growth. AI has a great future. NVIDIA is dominant. It cannot go to $90. Well, my reaction is I don't care. I don't care about if you have that opinion and if you want to buy, you just can go buy. But this is my valuation at this moment. Thank you for watching. If you have any question, feel free to leave a comment on the video and keep eyes on my update in my thread, in my LinkedIn and my YouTube channel. Thank you.